All right, my friends, so we're going to analyze a mutual fund. Chris had written in about this fund, and I want to dive a little bit deeper into it because Chris had a large unrealized gain in here, and this fund is paying out $20,000 a year in undistributed capital gains and dividends. He's like, man, should I sell it or what should I do? Pablo just, he just clicked up reply to the email Chris had sent me. I'm not sure if Pablo sent an email or not. He walked over the keyboard on the Chromebook. I love you, dog. You are. Oh, my goodness. Oh, dogs bring so much joy to one's life, I tell you. Anyway, so Chris, if you got this email and there's a bunch of gibberish, blame this guy. Don't blame me. All right. Such a button job. Look at this guy. He went over the email of the keyboard and his long nails got caught in it and he slipped. All right, so here's the fund. The Ivy Core Equity WCEAX. So I'm going to show you how I analyze a fund. Now, first and foremost, it's got $4.1 billion. That's important. That means it's not shutting down anytime soon. So you always got to remember, when it comes to mutual funds, there's this thing called survivor bias, and that means if a fund has less than 100 million, it's not going to be around for long because the regulatory environment for funds to sustain themselves with less than 100 million, unless they're part of a huge firm like a Vanguard, Fidelity, it's not likely. So in this case, 4.1 billion is a good asset size. Expense ratios on the high end, 1.02%. In of itself, that doesn't bother me all that much. I mean, I wish you did an index fund, but be it as it may, this right here isn't the reason to sell it. Unfortunately, Chris is apologetic. He goes, I wish I would have known about the fee. I feel bad that I had to pay the fee for all these years, but it is what it is. Fee level is below average. The load, well, he's already paid the front end load because he paid, I think he said he put in about like $500 a month for 2 years or something like that. Now it's worth $200,000. Anyway, but so he already paid the load. So the load in of itself is irrelevant now. But just to let you know here, you got a front end load of 5.75% and a 1% expense ratio. That's a doggone expensive mutual fund. Now this fund has been around a long time, so these older funds are going to be like that. You have an A share, which means you're paying the front end sales commission. That means you paid this right here. Now, again, Chris paid it in the course of over, many, many moons ago where he paid that load. But usually, if you have a front-end load of 5.75%, the fee should be lower, generally speaking, because you already paid a significant portion of your commission. The fact is a 1% fee on top of front-end load is bad. Let me give you an example. I'm going to go to American Funds real quick. We'll say AIVSX. The Investment Company of America, one of my favorite funds. And again, it's a 2-star rating. And here you see it's got a front-end load of 5.75. Its A share means the A means you pay the front-end load. And there he goes again. So you're paying this 5.75. That's the max, by the way. Not everybody's paying 5.75. There are break points. The more you put in, the less of a commission you pay. But you see the A share 5.875, but then the expense ratio is about half of that Ivy fund. Now, American Funds Investment Company of America has got $100 billion in assets to show you the size of the portfolio. That's a significant portfolio for sure. Now, just because it's 2-star, I mean, look, I do think Morningstar has valid ratings. Don't get me wrong. I've done blog posts on that. But at the end of the day, the 2-star isn't what makes or breaks it for me if you've already owned the fund. All right, so let's go back to this. So Chris says, when a salesman sold me the fund, it was originally the United Income Fund. All right, they have merged or changed the fund 3 times to what it is now. Yeah, so a lot of these, that's survivorship bias. I mean, a lot of these underperforming low asset funds will merge into new funds, and their previous track record just disappears, just goes away. It's nuts. And so what you'll see is you have all these mutual funds out there with above average performance. You're like, well, how can that possibly be? Because the old mutual funds that had poor performance just get closed up, and that performance record does not stay. It's crazy. So you got to be careful Our fund is at average, had better than average performance. Well, because the losers are gone. All right, so we got. I'm embarrassed by how much fees I paid for this fund. This is when I first got my first job, and you had to pay a broker to buy stocks for you. The fund rep advised me to invest in after tax because at the time I had plans to use money for a home purchase. Yeah, I got no problem with that. So Chris is, this is a brokerage account. It's a taxable account as opposed to an IRA. And the rep served him right there. He goes, look, if you're going to use it for a home purchase, you don't want an IRA for sure. They just moved the fund to the Ivy firm, the last year. Any chance my cost basis started with a new fund? No. Okay, so Chris is saying, look, they just merged the old fund into this fund. Any chance that the cost basis, because he doesn't know what cost basis is, has started with a new fund? And the answer is absolutely not. So the cost basis, all the IRS cares, they just care what you bought it at and what it's worth today. The fund has 1.02% fee, which we just talked about. And I don't like taking money out of savings every April to pay taxes, but I can show you why that's happening right here. That's why I moved the fund to my TD Ameritrade account to find a lower maintenance fee and more tax-efficient fund. However, I did not realize I'd have to pay long-term gains when I sell it as well. So what's happening here? See his turnover rate, 97%. So that means the fund turns over its portfolio each and every year. Every stock it owns a different stock within the course of that year, which is going to be incredibly tax inefficient for sure. All right, so it only has a trailing 12-month, that's what TTM stands for, a trailing 12-month of 0.5% dividend yield. And the reason for that is because it's on the growth side. So we want this kind of fund in your taxable account. So you're not getting, my man Chris isn't getting hit with a big dividend yield, which is good. So these are the kind of funds we want in a taxable account because the dividends aren't going to be big to any stretch of the imagination. So he's got $200,000 in here. It's getting $1,000 of dividends. Not a big deal. Is that turnover? That's a killer. So we want high growth. We want growth stocks, low dividend yields with low turnover. And that's where if you go to VBK, let's go to VBK. Does it do index ETFs here? Let's see if it does ETFs. So let me show you. It doesn't do turn. What would be the? I'm trying to think with the NAESX. NAESX. Yes, right there. Okay. Well, let me just. This is a Vanguard Small Cap Index Fund, and what you'll see is a turnover of 50. Now this is right there in the blend. So this isn't growth. So it'll be a higher yield. I don't know what a Vanguard Small Cap Growth Index Fund would be, but anyway. You have a turnover of 15%. So if on the growth side, it'd be about 0.53 like Chris's was, but a turnover on the low side, which means it's incredibly tax efficient. All right, so the lower the turnover, the more tax efficient it is. So let's go back to, I don't think it has turnover on the ETS, and it won't matter, frankly. Well, there's the yield right there, 0.57. So small cap growth has a yield of 0.57, similar to what Chris's is, but a turnover rate a heck of a lot lower, 1/8 of what Chris's is. And this is one of the cheapest funds of its kind. I actually own this in my M1 account, by the way. This is what I own in my M1. And remember, if you invest in an M1 account, you do it through my link on the side of my webpage or in my show notes here, I get paid commissions. Well, not a commission, a referral fee is what it is. So if you do open an M1 account, I do get paid. So if you're going to open one, just open it through me. I get paid. It doesn't cost any money. All right, so we talked about its low yield, which we like. We like a low yield and taxable account. We do not like a high turnover, and we certainly don't like a high expense ratio. We like the fact it's growth. All right, so now what we're going to do, though, is we're going to go to tax. Looks like the changes around a little bit. So let's go to fund analysis. I want to go to tax. Let's see here. All right, goes. Do I have to pay for this? Performance. I just want to see the tax stuff, man. All right. Trailing returns. Don't care about. The returns we don't care about because he already has the fund. Distribution. That's what we want. Distribute. Okay. All right. So yeah. Well, I have a feeling my friend Chris is going to have a lot lower capital gain if he were to sell this than he thinks. Because watch this. In 2016, it paid 50 cents on 1317 of let me get my calculator. Hold on just a second. Good boy, Pablo. Good boy. So it paid 50 cents on 1317 net asset value. So 0.5 divided by 13.17. It paid 4% as a distribution payout. 2015, it paid, almost $1 on $13. 1 divided by 13. It paid 7.7% there. 2014, it paid over $1 on 1386. 1.1 divided by, another 8% there. 2018, it paid $2. Well, look at that, $2 on 1263. A 16% payout. Paid 22 cents in 2000, about $1 on, So here it paid 17 cents on. You'll see it didn't have much of a capital gain payout, and the reason was because it has so many capital losses here. So these are just long-term and short-term capital gains. It had 80 cents in 2013 on $13, so 0.8 divided by 13. So it pays 6%. So basically, this fund has been paying between 5 and 20% of his portfolio each and every year as long-term capital gains. And you can see the income, not much in terms of income. So very, very little income. So that's pretty significant. And what you'll see here is that the price per share hasn't really gone up much. 9.69. It's gone up 12.63 minus 9.69 divided by 12 divided by 9.69. So the price has only gone up by 30% in the last 10 years. So basically not much of a portfolio increase in terms of the price per share. So he hasn't really made much money in the last 10 years on a price per share. So his capital appreciation has been minimal. Chris, I bet you don't have much of a capital gain in here anymore. With that kind of dividends, distributions has been paying each and every year with that significant portfolio turnover. I bet if you sold this thing, you're not going to get hit nearly to the extent that you think, or what I thought. Now, I don't know. Don't do it just because I said I bet, because I have literally no clue whatsoever. Let's see what this table looks like here. Yeah, okay. Yeah, we already saw that. Let's go to returns. Look at this fund. It's an underperformer, big time. Yeah, so this fund's been underperforming big time for 10 years. 15-year return, 8.84, which is significantly lower than the index. Significantly lower than the index. Yeah, it's just because the fees are too high. And then I think they do after-tax returns here too. Let's see. If they do after-tax returns, I know Morningstar did. Maybe you got to pay for it now. Let's see if we go to distributions. Yeah, I can't remember. Fund analysis. Let's look at portfolio. They used to do after-tax returns here in Morningstar. I don't know where's that anymore. Let's see. Bear with me just a second. So it's a well underperforming fund, high taxes that you've already paid. So I have a sneaky suspicion a lot of the unrealized gains you've actually realized for sure. So again, I don't know, but this would be something. I don't know why they don't do the after tax stuff. They used to. One second. They used to do after tax returns. I guess they making you have to buy that now. That's too bad. Just 1 second. What if? All right, I don't know. I tell you what, hold on a second. So let's go to the Seeking Alpha, which some folks had mentioned to me before, which I like quite a bit. So I haven't really done anything on Seeking Alpha in terms of tax stuff here. So let's see. No, that doesn't. Key data. Let's see if we got key data. I just want to see SEC filings. There's some good stuff in here for sure. That's not what I'm looking for. I'm looking for tax stuff, and I don't see. So they got a dividend growth history. That's not. Oh, no, it's fine, and that's good stuff. Don't get me wrong, but I want to see. Yeah, I don't see any tax stuff. All right, so that's not. Let's just look at the. Let's see. I thought I saw SEC holdings here. Key data. All right, let's go see if we can't find the prospectus. Oh, SEC filings right here. All right, let's see what we got. Got no prospectus here. All right, so let's find the prospectus. Hold on a sec. All right, so here's the Ivy website. All we're trying to find is this after-tax returns, because all this is before tax returns. Let's see what happens. Let's see real quick. Perspectives, distributions. Yeah, it doesn't. Let's go down to. Let's just look at fact sheet. Let's see if it says it on the fact sheet, shall we? Let's make this bigger. There's a thing to make it bigger. Oops. There we go. Okay. No, it doesn't say after tax. Oh, that drives me crazy. All right, so we got to see prospectus in. Let's go summary prospectus, see if that does it for us. Right here. Here we go. All right, sweet. No. One second. We're trying to find. They're supposed to put in the prospectus. I mean, it's in here someplace. I just don't want to have to look through all. There we go. Sweet. Okay. So here's a summary prospectus. Class A, return before taxes, 11% for 10 years or life of class. I don't know. We'll just say 10 years. So 11% return after taxes on distribution, 9.68. So you are losing 1.32 divided by 11. You're losing 12% a year to taxes. That's just for sure. Now, when you sell the funds, is going to be after 9.02. So you have to look at this right here. So if you look at the return after tax, before taxes, and after tax on distribution, so just by sitting around looking out the window and watching the Patriots play, you lost 12% of the year on your returns simply because of tax on distribution. So, I mean, look, I can't tell you what to do, Chris, but that's how I analyze funds. So we get a high expense, low performing, low dividends, which we want, but a significant, look, it's old Waddell and Reed, yeah. Significant draw on performance because of taxes. So at some day you just, I mean, look, man, I don't know your circumstance, but at some point you might just want to bite the bullet and say, I'm just going to sell this sucker, move on. All right. Hope this helps. That's how I look at funds. We'll see you guys.